Welcome back to the Deep Dive. We're here again to really unpack complex corporate moves and figure out what's actually going on behind the numbers so you get the real story. And today, well, we've got something pretty interesting. We're diving into a bank that's, you could say, rebuilding itself from the inside out, this South Indian Bank, or SIB. We've got our hands on their investor presentation for Q2 FY26. That's the quarter ending September 30th, 2025.
That's right. And this isn't just a press release, you know. Our goal today is to look beyond the headline profit number. We want to uncover the specific strategies, the mechanics they're using to pull off this transformation they've been talking about.
It really gives you that strategic viewpoint, doesn't it, how the bank sees itself?
Exactly. Its strengths, challenges, where it's headed. It's quite revealing.
Okay, let's get into it then. The big picture first. This strategic transformation journey. They dated back to September 2020. What exactly are we talking about here? It sounds pretty drastic.
Oh, it really is. They call it churning the book. And the numbers are kind of staggering. Since October 2020, SIB has basically replaced around 83% of its entire loan portfolio.
83%.
Yeah, think about that. Almost, 8 out of every 10 loans they have now just weren't there 4 years ago? It's a massive overhaul.
That's huge. It suggests they were, well, willing to take some pain
to
get rid of older risk. So what was the strategy? What were they moving away from? And where are they heading?
Good question. They were definitely moving away from a heavy reliance on corporate loans, the big tickets, where 1 or 2 defaults can really hurt your year.
Right. Concentration risk.
Precisely. And they're running quite deliberately towards the smaller stuff, MSME, that's micro, small and medium enterprises, and core retail customers. Think home loans, car loans, gold loans. And it's worked in terms of diversification. The presentation shows that about 60% of their loan book now is outside of corporate lending.
So spreading the risk.
Yeah.
Makes sense.
Spread across thousands of smaller loans. It's just a different risk profile altogether, more granular.
And you can see the money flowing that way too, right? In the new loan numbers, I saw the Q2 FY26 disbursement growth year on year. It was 127% for MSME, the B segment they call it.
127%, yeah. Massive jump.
And 51% for retail, which includes gold loans. So they're not just talking about it, they're actually putting the capital there.
Definitely shows intent. And you need strong leadership to drive that kind of change so quickly. It's worth pointing out the presentation mentions the MD and CEO, Mr. P.R. Seshadri.
Yes.
Over 30 years in banking, former MD and CEO at Karora Visa Bank, senior roles at Citibank. I mean, this isn't someone new to big transformations or risk management. That experience probably counts for a lot here.
Absolutely. That context is key. Because this kind of shift, it has to show up in the financials eventually, right? Let's look at those Q2 numbers. How is the bank actually performing right now?
Well, on the surface, things look pretty solid. Profit after tax for the quarter, Q2 FY26, was Rs 351 crore. That's up about 8% compared to the same quarter last year.
Okay, steady growth.
And for the first half of the financial year, the HY1 PAT, it's Rs 673 crore, which is a 9% increase year on year. So consistent upward trend.
And what about the efficiency metrics, like return on assets and equity?
Yeah, those look stable too. Return on assets, ROA, for the quarter was 1.02%, and return on equity, ROE, which is, key for shareholders, came in at a healthy 13.11%.
13.11.
Okay.
And deposits, the funding side.
Seems very solid. Total deposits over R is 115,000 crore, and the vast majority of that, almost R to 13,000 crore, is retail deposits. So it's a sticky, stable base.
And their TSA ratio, the cheap funding.
Holding steady, 31.86%, which is pretty competitive. They also make a point about their NRI deposits, non-resident Indian deposits.
Right, saw that. Over 33,000 crore.
Yeah, and that's typically quite stable funding, helps keep their overall cost of funds in check.
Okay, so profits are up, returns look decent, deposit base is solid. There was one number that caught my eye, the net interest margin, the NIM.
Ah, yes. The N, that's where things get interesting. It stood at 2.80% in Q2 FY26.
2.8, which is, correct me if I'm wrong, down from last year. I think it was over 3%, like 3.24% in Q2 FY25, and down from the previous quarter, too.
You're absolutely right. It has come down.
So why? Why would margins be shrinking when they're growing disbursements so fast, especially in higher yield segments like MSME and retail? Is that a worry?
It's not necessarily a worry, but it is definitely a strategic choice. It's a trade-off they seem to be consciously making.
Okay, explain that.
Well, think about it. They're pushing aggressively into retail and MSME. These are competitive markets, right? Things like gold loans, vehicle loans. Lots of players want that business.
Sure, competition drives down prices, or in this case, interest rates they can charge.
Exactly. So they're likely accepting a slightly lower margin, that 2.88% IM, to gain market share and build volume quickly in these safer segments. It's a deliberate sacrifice of some margin now.
In exchange for what? Lower risk.
Precisely. They're betting that the cost of bad loans, the non-performing assets or NPAs in this new, carefully underwritten retail and MSME book will be much lower than the cost of bad loans in the old, lumpy corporate book.
Ah, I see. So even if the revenue margin, NIM, is a bit lower, the net profit could be higher or more stable if they save a lot on credit costs down the line.
That's the calculation. Trading margin for risk reduction and hopefully long-term stability. It really puts the focus on asset quality, doesn't it?
It absolutely does. And speaking of asset quality, this seems to be where the real aha moment is in this presentation. The improvement looks, well, dramatic.
This is where the story really comes together, I think. The numbers are quite stark. Gross NPAs, the total bad loans, down to 2.93%.
2.93. Okay, that's quite an improvement from where many banks were a few years ago.
Yeah.
But the net NPAs,
The net NPAs, the NNPA, that's the crucial one, right? After provisions, it's dropped to just 0.56%.
0.56%. That's incredibly low.
It is, and they explicitly mention this is below their pre-COVID levels. It's like they've not just recovered, they've actually emerged cleaner than before the pandemic disruption.
That's remarkable. How did they manage such a cleanup alongside that massive book churn?
Well, this is the clever part, and they lay it out clearly. You have to look at how they split the loan book internally. They talk about the old loan book, everything originated before October 2020, and the new loan book, which is everything since the transformation began.
Okay, old versus new. And I bet the risk profile is totally different.
Night and day. Get this. 86% of all their current gross NPAs come from that old book.
86%. So the legacy assets are where almost all the problems lie.
Exactly. And look at the actual NPA rates. The gross NPA for that old book, it's still sitting at a very high 14.90%.
14.9%. Okay, so that's the anchor they're dealing with. But the flip side, the new book, the one built under the new strategy.
This is the number that tells the story. The gross NPA for the new book is just 0.48%.
Wow, 0.48%.
Almost pristine.
That single number, 0.48%, that basically validates the entire strategy, doesn't it? It shows the shift to retail MSME, combined with whatever new underwriting or processes they put in place, is working incredibly well.
It absolutely does. It tells you the new engine they've built is generating very high-quality assets almost from day one. That 0.48% is what the market will look at for future performance, right? The 14.9% is sort of a legacy issue they are managing down.
And managing it down responsibly, it seems. They mentioned the provision coverage ratio, PCR.
Right. PCR, including write-offs, has been boosted significantly. It's now at 90.25%. That means they've set aside a lot of capital to cover potential losses from that remaining old book. It cushions the risk.
Makes sense. They're isolating the old problem and building a clean future. Even the remaining corporate loans seem high quality.
Yeah, they point out that 98.4% of their standard large corporate loans, the big ones, 100 core plus, are rated A or better. So even where they retain corporate exposure, it seems to be top tier.
Okay, so strategy shift, asset quality turnaround.
Mm-hmm.
But none of this happens without the engine room running smoothly.
Yeah.
Right? The operations and technology side must be critical.
Absolutely essential. You can't scale up retail and MSME like this, maintaining quality, without massive efficiency gains, largely driven by tech.
And the numbers show that.
They do. Look at digital transactions. They now account for 98.44% of all transactions in Q2 FY26. That's huge.
98% digital.
Handling over 4.1 million transactions digitally on average every single day. That level of digital adoption is the bedrock for efficiency.
And that translates to productivity, like in the branches.
Directly. They have this metric, branch value added or same-store sales value added. They indexed it to 100 back in Q4 FY24. By Q2 FY26, just, 6 quarters later, that index hit 219%.
219%. So branch productivity more than doubled in a year and a half?
That's what the index suggests. It's a massive jump. And it clearly comes from automation, digital processes freeing up staff time.
Which should help the bottom line, the costs.
Exactly. And it does. The cost-to-income ratio improved. It was 58.7% in Q2 FY26, down from 59.6% a year earlier. So they're becoming more efficient even as they grow.
But it's not just general tech, is it? They seem to be building specific tools for specific loan types, making things frictionless.
Yeah.
That must be key for that low NPA on the new book.
Totally. They highlight several new STP initiatives. That's straight-through processing, fully automated, end-to-end loan processing with minimal human touch.
Examples.
Well, there's SIB Gold Express, a new gold loan product designed for speed, maybe with simplified income checks. Then PowerDrive, which is an in-house STP system for vehicle loans. And EOS Power, an STP loan origination system for affordable housing.
So specialized digital factories for different products, designed for speed, consistency, and probably automated risk checks built in.
That's the idea. Build quality and efficiency right into the process from the start. That's how you get that 0.48% GNPA on the new book, even with rapid growth.
And they're using partnerships too, aren't they, to expand reach digitally?
Yes, smart co-lending seems part of the strategy.
Yeah.
They mentioned partnering with Godbridge Housing Finance for home loans. And a really interesting one, working with Catflip Financial Services, which operates as Axio,
Actually, you're right.
to provide checkout finance for Amazon customers. That's a pure digital play, isn't it? Accessing a huge customer base online without needing physical branches everywhere.
Very clever. Using partnerships to scale the high-quality retail book fast.
Okay.
Okay, so we've covered a lot of ground here. Let's try and distill this. For you, the listener, taking this deep dive with us, what are the core takeaways from SIB's transformation story?
I think there are three big ones. First, the sheer decisiveness of the portfolio shift. They didn't just tinker, they fundamentally re-engineered, turning 83% of the book away from corporate risk towards retail and MSME. That took courage.
Right. Second, the results in asset quality are undeniable. That NNPA down to 0.56%, and especially the stark difference between the old book's 14.9% GNPA and the new book's 0.48%, that proves the new model works, even if it meant accepting slightly lower NIMs initially.
Absolutely. And third, none of it would be possible without the operational muscle powered by digital. That 98% digital transaction rate, the doubling of branch productivity, it shows deep investment in efficiency is enabling this high-quality growth.
So tying it all together, maybe the most revealing thing is how openly they discuss the old versus new book. That transparency itself is strategic. That 0.48% is a beacon.
It really is. And maybe the final thought for you to chew on is this. That split demonstrates the incredible discipline needed for a bank to truly transform. You have to isolate and manage down the past while building the future on entirely new, much more rigorous systems. It shows that legacy baggage is real, but strategic growth has to come from clean foundations.
A lesson in cutting the anchor loose while building a faster ship. Fascinating stuff.
Indeed. The proof is in that GNPA split.
That's our deep dive for today. Thanks for joining us. We'll see you next time.